All right, let's get right into it. Today, we are breaking down a really interesting topic for anyone thinking about retirement income, an ETF called TSPY, which has a strategy that's been promising some seriously high yields.
You know, it's that classic retirement problem, right? You've worked your whole life to build up this nest egg, and now the big question is, how do you make it generate a paycheck you can live on?
But at the same time, you're probably not ready to completely give up on the stock market's growth potential. You need that cash flow for sure, but you also want your money to keep working for you. So, what's the move? How do you get both? Okay, so this is the number that's got everyone talking. A trailing 12-month yield of around 13%. I mean, a number like that could be a real game changer for a retirement plan.
And that, right there, is the big promise of TSPY. It's an ETF designed to do exactly that, balance income and growth. But let's be real, whenever you see an eye-popping number like this, you gotta ask, what's the catch? To get that kind of income, you have to give something up. So where does it come from, and what's the real price you pay? Okay, let's dive in and find out.
Okay, so first things first, what exactly is TSPY, and why is it making such a splash right now?
At its heart, TSPY is an actively managed fund that really just does two main things. First, it owns the S&P 500, so you get that broad exposure to the stock market. Second, every single day, it sells these things called covered call options to generate cash. The whole idea is to basically turn the market's everyday little movements into a steady stream of income for you.
Now you gotta know, this is a pretty new fund. It only launched back in August of 2024, but man, has it been growing fast. It recently blew past the $100 million mark in assets and was sitting at around $120 million by the end of October 2025. That kind of growth definitely tells you that investors are paying attention.
All right, so how in the world does it actually generate that 13% yield? Well, that brings us to what's really under the hood, the fund's unique daily engine.
And listen, this is the big difference. Most funds that do this kind of thing, they do it weekly, maybe monthly. TSPY, it does this every single day. It's built specifically for this new world of super short-term options, the ones people call 0 DTE, or 0 days to expiration. So here's how that daily machine works, broken down for you. Step 1, the fund owns the S&P 500. Simple enough. Step 2, every morning it sells call options that are a little bit above where the market is trading at that moment, and here's the key, they expire that very same day. Step 3, it collects the cash, or what's called a premium, for selling those options. And finally, step 4, it takes all that daily cash it collected and pulls it together to pay out a monthly distribution to you. And that brings us right back to the most important thing to understand, the trade-off. There's no free lunch here. When you use a covered call strategy, what you're really doing is agreeing to sell off some of the market's potential home runs. In exchange for what? You get paid cash, right now, today. And with TSPY, that's a deal you're making every single day.
Okay, this is probably the most important part of this whole discussion. We need to understand the risks and what the real price of that high income actually is.
And let me just be crystal clear here. Is that yield guaranteed? No, absolutely not. Anytime you see a yield this high, there are always strings attached and potential downsides you have to wrap your head around.
This chart really tells the story. Think about two different market scenarios. First, a roaring bull market, where stocks are just ripping higher day after day. In that case, TSPY is almost certainly going to lag behind the S&P 500. Why? Because those daily calls it sells act like a ceiling, capping its potential gains. But what if the market is just stuck, kind of choppy, going sideways, not really doing much? Well, that's the sweet spot. That's where this strategy can really shine by just consistently raking in that daily income. And this slide lays out those risks perfectly. You've got that capped upside we just talked about. The yield itself also really depends on market volatility. If the market gets calm, those option premiums get smaller and the yield could drop. Then there's the short track record. It's still a new fund. Also, the income it pays out is usually taxed at higher ordinary income rates, not like qualified dividends. And you can't forget, you still own stocks. If the market takes a nosedive, so will the value of your investment.
So, to put this all into perspective, let's quickly compare it to another popular income fund, SPYI. The big difference really jumps out at you, right? It's that options cadence. TSPY is all about that daily 0 DTE strategy, trying to capture tiny price moves every single day. Meanwhile, a fund like SPYI works on a more traditional monthly schedule.
Okay, so we've gone through the what and the how. Now for the really practical part. How would something like TSPY actually fit into your portfolio?
Let's make this real with some numbers. Say you have a $500,000 portfolio. An allocation of that size into TSYP at a 13% yield could potentially generate around $65,000 a year in pre-tax income. Now, of course, that yield is going to fluctuate, but you can see the kind of cash flow we're talking about here.
Now, and this is super important, a fund like this is not meant to be your whole portfolio, not even close. Think of it more like a slice of the pie. In this example, you've got your core stocks, and then you have this dedicated income sleeve, maybe 30%, where a fund like TSPY could sit next to other income plays. And all of that is balanced out by safer stuff like bonds and cash to act as a cushion.
And if you're thinking about this, here are a few practical tips. First, you might want to start small, maybe a 5 to 15% allocation to your portfolio. Also, think about where you hold it. Because of the way the income is taxed, it's often a better fit for a tax-advantaged account like an IRA. And hey, if you don't need all that cash flow right away, reinvesting some of it is a great way to help your original investment keep growing.
You know, there's a quote from the source material that I think just nails it. It says, TSPY isn't magic. It's a workhorse, a tool designed for a very specific job, creating a big stream of cash for people who still want to be invested in the stock market for the long haul.
So, in the end, it all comes down to one big question. A question you really have to ask yourself. Is that consistent high income today more important to you than giving up the chance to capture the market's biggest home runs tomorrow? There's no right or wrong answer, but that's the fundamental trade-off you're making here, and it all depends on what you truly want out of your retirement.